Okay, so we just have a quick start of business valuation. Then we move to the equity valuations. We have different valuation methods. So first of all, we would like to introduce the income or earnings-based method, the PE ratio or the PE multiple. The formula is easy. The market price per share divided by the earnings per share. So the PE ratio is, or ascribed to the target, represents the number of years earning the acquirer is prepared to pay for it. Okay, so what, for example, what does a PE multiple 12 times mean? If it is a company XYZ, what does it mean? Okay, it means 12 times of earning per share, the market price trading at 12 times of earning per shares, right? If the EPS is $2, so with 12 times PE multiple, the market price is $24 per share. So I pay $24 and the earning per share is $2, so it needs to have 12 years earning for the acquirer to get from this company, assuming every year the earnings per share is the same. So I pay 12 years earning for this company if it is 12 times of PE multiple. And as I said, or as we said before, a high PE multiple company, say for example 20 times multiple or 10 times multiple, why people would like to buy a company with 20 times multiple instead of 10 times multiple? Because 20 times multiple may indicate the growth, the company earning per shares growth is better. So the market participants or the investors would like to pay the premium for this company because it buys the growth prospect. And in general, the bid in the market news, a lot of buyer or the bidder would like to use the PE ratio or PE multiple in the acquisition or the valuation. Okay, because it is straightforward. It is straightforward, simple way to evaluate a company. And if they are in the same industry, then it can benchmark with different companies. For example, with a bit higher PE ratio, it means a company with higher growth rate. But the weakness is PE ratio is produced from the accounting data. So, and also it is only a snapshot of profits. It does not integrate any synergies. It does not integrate any synergies in the calculation. For synergies means after acquisition. For example, acquisition means 1 plus 1 is it equal to 2? Maybe not, right? Because inside is synergies. So for synergies means one company plus one company. Okay, the value should be more than 2, like for example 3. Okay, the differences between just 1 plus 1 equal to is the synergy. Okay, synergies is a term describing the acquisition of a company can create more value to the investors or to the shareholders. So as I said, high PE ratio is only a perceived, right? Perception of high potential and the likelihood of growth. And here are two terms, or one term. Okay, one term to be explained. For earnings yield, the earnings per share for the most recent 12 months period divided by the current market price per share. So it is just the reciprocal. Okay, here is the PE ratio, right? Here the PE ratio, and for the earnings yield, it is the earnings per share divided by the market price per share. It is the inverse of PE ratio. So in the examination, don't be afraid. Okay, for example, if it is 20 times PE multiple, okay, it means 20 times over 1. So just take the inverse. It means earning yield is 1 over 20. It means 5%. Okay, so the earnings yield or the return is 5%. Then the multiple is 20 times the PE ratio is. Okay, just a term describing the same thing. For PE ratio, the weakness, as I said, it is produced from the accounting data, and it is not an economic assessment of company position. It reflects the snapshot of profits. And for synergies, as I said, as I explained what is synergy, it is difficult to build the post-acquisition synergies in the PE calculation. But it is the simple way and also the straightforward way to make the equity valuation of a company. So next is the asset-based valuation. The method or the model we are describing is asset valuation model. Okay, in the same as PE ratio, it is simple. You just check in your, for example, in your examination, past examination paper, some question are asking about the asset valuation model in the multiple choice questions. Then the formula you have to remember: the tangible and intangible assets less the value of liabilities. It means the equity. Okay. Divided by the number of shares. So remember, there's also market value and book value. So here, it's about the book value. But if we have the valuation reports or the market valuation report, then it can be a market value numbers. Even it is simple and easy to use, but the weakness is it is difficult to put a value on intangibles. Intangible value is difficult to estimate as well. And for fixed assets, the value of replacement value or discounted cash flow value is arguable. Sometimes, okay, maybe people using the replacement value. Okay, but if the assets are generating positive cash flow and the asset will create more value to the business, but if you only use the replacement value, then this method is not applicable, especially for some goods with high goodwill or patent. The replacement value of the machinery is maybe only 10 million. But if the machines can produce a goods that is unique in the market with its goodwill and patent, for example, that the value may be much higher than 10 million, but if the replacement value is so low, then it does not give a true picture of the assets. Also, hard to apply for a company with almost entirely intangible assets. For example, a servicing company. It has very small amount of tangible assets, maybe, or very small amount of measurable assets value. A lot of the value is coming from its people, its network, and also its service quality. But all those parts cannot be valued by the assets because they are intangible. They cannot be touched. They cannot be valued. And it doesn't account with any profit-related calculation. So, for example, it doesn't account for any cash flow or dividends. So maybe it's the best way to use the asset valuation approach is usually used for some companies like heavy asset or weighted, like the properties investment company. Okay, like it invests a lot of real estate projects, hotels projects, a lot of investment properties projects. So I can value by the tangible by this asset valuation model. And also for small companies may be good because a lot of items, a lot of assets may be just pooling in the operations for a small company. And for small company, because it would like to use a more simple way to do the valuation. So asset-based valuation is a good way as well. So another term would like to highlight here is about the super profits. For super profits, any profits earned in excess of expected rate of return resulting from synergies and competitive advantages, then it comes out to super profits. Okay, just the terms that for you to understand. So the second valuation model, we talk about income-based valuation. We talk about asset-based valuation. Next is cash flow-based valuation. We all learn for the NPV, for the net present value. During the acquisition, NPV valuation method can be done in two ways. First, you can use, for example, operating cash flow generated by the target business standalone to estimate the value. Next is you apply the operating cash flow of target plus any synergies generated after acquisition. So you can work in two ways, or you can work both ways, because the first one here is provide you the lower bound of the value, right? Because it's just standalone, the business without any synergies, without any value added, just standalone base to see the lower bound value of the target. And here is the upper bound. So you have the lower bound, you have the upper bound value of a company that you would like to acquire. Then you can make your offer. So in general here, you would like to acquire a company. Then you will see what price you would like to offer. It depends on how much incremental value or incremental cash flow generated. Okay. Then you pay for it. If there's no incremental cash flow generated, then you just stand alone, then you buy it with the lower price. Okay, the set normal practice is to calculate incremental cash flow. For discount rate to be applied, we remember use the project specific discount rate. Okay, all these we have discussed it before. So cash flow based valuation. Last one is the fourth one. Sorry, this is the third one also, but with different business model. Okay, we just mentioned about the net present value. Here, discount the dividend valuation model. So I would like to put a star here because it is quite often in a multiple choice question, in the objective test question, examiner would like to test whether you can understand well of the dividend valuation model. Okay, for example, I still remember 1 year, not only 1 year, multiple times providing you D0, D1, and then providing you the ROE, okay, asking you what's the price. So you have to remember this formula, and you have to check this in the formula sheet to come out the answer. So here is a very important topic that I would like to highlight for you. And to any individual shareholders, the value of share can be argued as all the future dividends generated into perpetually. So for dividend valuation model, it is good for whom? It is good for minority shareholder because the minority shareholders is only looking for dividends, right? It is good for minority shareholders. For the NPV or for PE multiple, these valuation tools are good for acquisition, okay, or major shareholder. Because for major shareholders, okay, for example, I would like to buy a company for more than 80% of shares, then its cash flow generated, I will be benefited because I can utilize the cash flow generated to build other business or to grow the business. For the earning per share or for PE multiple, it can help my company as well because when I acquired a low PE multiple company, my earning per share, my PE ratio will be lowered as well. But it's good for the major shareholders. But for minority shareholders, okay, it doesn't any matter for them. No matter it's high PE ratio or net present value method, it doesn't contribute to their pockets because they are only concerned about the dividends. So for the minority shareholders, they are looking for valuation method is mainly for the dividend valuation model, especially when the dividends are paying to them a good or in a growing trend, then they can assume it can grow perpetually. It can pay higher price for those with high growth dividend rate company. And the problem is assume dividend policy accurately reflects future cash flow is a problem because you cannot assume the dividend policy will be sustained for say 5 years or more than 5 years. Okay, will be a problem. And also growth rate and discount rate assumptions. Okay, because in dividend valuation model, it always true that cost of equity always higher than the growth rate. Okay, it's the assumption behind. Okay, it cannot be in the inverse situation. And shareholders are only interested in the dividend. So it is the minority shareholders' interest, but may not be major shareholders or some equity, some like the hedge fund or the private equity investors are looking for. So we talk three methodologies. We talk income-based approach. We talk about the asset-based approach. We talk about the cash flow-based approach. For cash flow-based approach, we talk about the net present value approach, and also we talk about the dividend valuation model. So here we can sum up for the equity valuation. For the quoted companies versus unquoted companies valuation is different. For asset valuation, it may be the most relevant to the owner of a private company, as offers will be few and future earnings difficult to calculate. So it is good for the owner of private company, especially for the unquoted one, for example. Because for unquoted company, the PE is a question mark. There's no market price, right? For the cash flow model, like MPV or the dividend valuation model, it is difficult to estimate the RE, the cost of equity, and it is difficult to estimate the dividend growth rate, as well as the project-specific discount rate, as shared with you here, the RE. Okay, so for the small company or the private company, unquoted companies valuation, asset valuation seems is the best way to do it. For the PE ratio approach or PE multiple approach, with the PE adjust downwards for the lack of marketability, so it's the problem, but it's still widely accepted because it is good for the big companies. It is good for the big companies to make the acquisition, okay, because it is easy to present the rationale, the logic, and especially when people look at the high PE company acquiring low PE company. Okay, for example, right now, some US high-tech company, the PE ratio may be 150 times. So it means the investor are paying 150 years of the earnings per share to buy the companies. So it's crazy, but the people are looking for growth. Maybe the growth rate is so fast, then it's not 150, maybe say only 10 years, for example, because the growth rate is so fast. And the last valuation method we mentioned or we share is the dividend approach. This is best used for the valuation of a minority holding, the MI, as it is difficult to adjust it to impose a premium for control. Okay? So that's it. Super profits approach, yes, we mentioned. So